We're taking a look at stocks trending lower once again this morning. Further signs of the rally that seems to be losing steam. The Dow coming off its worst week that it's had since the start of the year. A lot of the losses being driven by the decline that we have seen in tech stocks. So what should investors do? We want to bring in George Pearkes. He's Bespoke Investment Group's macro strategist. George, it's good to see you here. So here we are starting the week again with the markets taking a leg lower. Is this indicative maybe of a larger pullback that investors should be expecting?
Thanks, Sean. Good morning. And yeah, I think one of the biggest things to remember in this leg lower we've seen since last Friday is that it's being led by the same stocks that led to the upside, which is the AI basket of stocks across tech, across communication services, and some consumer discretionary names as well. And that pullback is definitely long deserved. We've seen trillions of additional market value around the world added through the AI craze that has been running since ChatGPT was introduced. And so eventually those sorts of trades hit an air pocket at least. That doesn't mean that we're going to see them reverse entirely or anything that dramatic, and further upside gains are certainly possible. But what we're seeing is leadership to the downside from some of the same names that led the rally to the upside, which is what you would expect after the market has had such a strong run, and especially some sub-pockets of it, namely AI.
Do you think that this could initiate any type of massive wave of rotation into other sectors?
No, I think any big rotation is going to be driven more by macro factors as opposed to what's going on inside the equity markets. So what we've seen over the past few months is that this boom in AI stocks has driven a large share of the gains. There have been big leadership from AI stocks, and some of them have gotten so large, whether it's the big name brand tech names or stocks that are newer in terms of being mega caps like NVIDIA. They're so large now that they're driving an outsized share of the gains that makes the market look quite narrow. But there has been reasonably broad participation across the market. The number of stocks that are hitting new 52-week highs has been elevated versus history, and that's been confirming the move in price. And so when you see those two things together, you tend to see strong gains continue, historically speaking. I think if we do see a major change in tone from the Federal Reserve towards a more dovish monetary policy, that could start to kick off a more dramatic move across the market from some names that have been beaten down but haven't really participated in the AI move. So for instance, your real estate stocks, banks have also been performing quite well of late, despite some of the headwinds for smaller banks. There's a number of different sectors that look ready to rock higher if we start to see a more dovish pivot. So far this year, the Fed has really resisted that, and we'll see coming out of CPI tomorrow whether that's going to continue into the March FOMC meeting on the 20th.
George, if we do see a further delay in the rate cut, what is that then going to do for your positioning, and what you expect then to outperform between now and the end of the year?
Yeah, I think a delay of signals around the rate cut from, the sort of two scenarios that are possible are saying, okay, we're teeing up a rate cut in May, which would be more dovish than where the market has been guided by the Fed so far this year, versus we're going to tee up a rate cut in June, which is sort of closer to current consensus. If we see the latter, so that is the Fed tees up a rate cut in June, signals through both the summary of economic projections forecast and through Chair Powell's commentary and the FOMC monetary policy statement, if they tee up, if they rule out May basically and say we're headed towards cuts, but we're not going to go at the next meeting, that won't necessarily be a huge headwind for the market. I think if the alternative is that they tee up May and say, okay, we're starting to discuss cuts now, and we're looking and imply that they're signaling May. That would be a very big positive. So I do think there's a bit of asymmetry around what the Fed is teeing up into this meeting. And it'll be interesting to see how markets sort of try to front run that based on whatever happens with CPI tomorrow.
Where are the areas that you expect the market to front run that, or where are the places that you expect investors to start perhaps cashing in on now and then preparing for where they could perhaps pile back into the market at some more reasonable valuations once we do see more firm signaling of a pivot from the Fed?
I think bond proxies are the most straightforward way to look at it. So your utilities, your REITs, and some consumer staples names that really tend to have long and very stable cash flows. Tech also tends to fall into this bucket, but it's in the last year or so, it started to diverge a lot from those bond proxies because of this dynamic of AI, which is this huge growth story that investors have grabbed onto. So all things equal, I would expect those sort of more defensive bond proxy type sectors to be where some of the best returns come if we do see a significantly more dovish than expected and more dovish than guided Fed over the past few months, when we get CPI data tomorrow and then when we actually get the March FOMC meeting next week.
Bespoke Investment Group macro strategist George Pearkes. George, thanks so much for taking the time here this morning.
Thanks, Brad. Nice to talk to you all.